Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within corporate filings and get ready. Because today we are diving into a move that sounds like a biggie, a company shedding some serious real estate and equipment, and we will break down exactly what that means for their bottom line and their future. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you are subscribed. Also, we have a Discord community linked in the description below where you can chat with fellow corporate explorers. We are looking at a filing from WillScot Holdings Corporation, and it seems they are making some major changes to their physical presence and their rental fleet. This is essentially a report detailing significant costs related to exiting or disposing of certain business activities. So, what is happening here? WillScot Holdings Corporation, which deals with modular and storage rentals used by businesses, is looking to slim down its physical footprint. As of late last year, they had around 400 locations, many of them long-term leases for their branch operations. Now, after integrating their operations last year, they've been looking at their properties to cut down on real estate costs while still being able to serve their clients. To make this happen, they've decided to get rid of some of their rental equipment, specifically units that have been sitting idle for a long time, are not standard or are costing a lot to repair. They've essentially depreciated this idle equipment down to its scrap value, and get this, over 11 months ending in November of last year. This meant an extra $41 million in depreciation costs. That's a significant hit to their reported profit in the short term. But the big news is that in December of last year, the company's board officially approved a plan to optimize their network over the next 4 years. This isn't a small tweak, this is a major overhaul. They plan to exit about 725 acres of leased property. This means closing down roughly 115 locations, which represents about a quarter of all the land they were leasing. And to make these exits happen, they are going to abandon rental fleet units that currently have a book value of up to $315 million. Now, they expect to get around $8 million in scrap proceeds from this, bringing the net book value of the units they plan to abandon to about $311 million. This involves around 51,000 units in total, mostly portable storage and modular space units. Again, the focus is on those older, less productive assets. Why are they doing this? Well, they expect this move to save them between $25 to $30 million in annual real estate cost increases over the next 4 years. That's a substantial saving. They also believe they will still have enough equipment to meet future demand and maintain their service to all customers. Now, for the costs, this plan comes with a hefty price tag, at least on paper. They are recording about $303 million in non-cash accelerated depreciation. Accelerated depreciation means they are recognizing the full loss in value of these assets much sooner than they normally would. This is a big number and it will hit their fourth quarter of last year's financial results. On top of that, they are looking at unit disposal costs that will require future cash spending estimated to be between $40 to $50 million. These costs will be spread out as the units are actually disposed of, likely through 2029. They anticipate incurring net cash costs of around $20 million in 2026. The company believes that despite these upfront costs, these actions will actually boost their profitability starting in 2027. Of course, like most companies, they include a section on forward-looking statements. This is where they talk about future expectations and potential outcomes. They caution that actual results could differ from what they are projecting, and this is due to various risks and uncertainties in the market. They also mention that they don't plan to update these statements unless required by law, which is standard practice. Essentially, they're saying, this is what we think will happen, but the future is unpredictable. We also get a mention of exhibits, which often include supporting documents. In this case, it's the cover page interactive data file, which is basically part of the digital filing. And finally, the report is signed off by Hezron Timothy Lopez, who holds a senior executive position, Executive Vice President, Chief Legal and Compliance Officer, and ESG. The date of this report is the 22nd of December 2025, reflecting the most recent events. So, what's the big picture here? WillScot Holdings Corporation is undertaking a significant restructuring. They are streamlining their operations by getting rid of underutilized real estate and old equipment. This is a strategy to cut costs and improve efficiency in the long run. The immediate impact will be a large non-cash charge for depreciation, which will make their short-term profits look worse. However, the long-term goal is clear: lower operating expenses and a more agile business. The opportunity is cost savings, and the risk is that the market conditions might not improve as expected or that their cost estimates for disposal are off. They are betting that these changes will make them a leaner and more profitable company in the coming years. Alright, that is our breakdown of WillScot Holdings Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.